What are segregated funds? Segregated funds are an investment product created and offered exclusively by life insurance companies. They are a type of insurance contract that provides guarantees to protect the value of the investment. They are a suitable choice for investors who want exposure to financial markets for investment growth or income but also want to limit their risk. Segregated funds offer many advantages to investors, which are detailed in the document. Key advantages of segregated funds. Guarantees. Segregated funds offer two main guarantees that protect the investor from losing their principal: a maturity guarantee and a death benefit guarantee. Maturity guarantee. This guarantee applies on the contract's maturity date, which is a minimum of 10 years from the first deposit. It ensures that on the maturity date, the policy owner will receive at least 75% of the total amount they deposited. Some contracts may offer a 100% guarantee, often with a longer maturity term, such as 15 years. The maturity guarantee provides downside protection by setting a minimum value for the contract at maturity, while also offering unlimited upside potential, as there is no maximum to what the value may be. Death benefit guarantee. This guarantee applies if the annuitant, the person on whose life the benefit is based, dies during the contract term. It ensures the beneficiary will receive at least 75% of the total deposits. Like the maturity guarantee, some contracts may offer a 100% death benefit guarantee. Guarantees and withdrawals. Withdrawals made from the contract will reduce the sum on which the guarantees are calculated, but they do not change the percentage of the guarantee. If the market value of the fund is less than the guaranteed amount at maturity or death, the insurer will top up the value to meet the guarantee. Growth secured by reset. Segregated funds may offer a reset feature, which allows investors to lock in a higher market value of their contract and set it as the new guaranteed value. A reset increases the maturity and death benefit guarantees and extends the contract's maturity date to 10 years from the reset date. Not all funds offer this feature, and some insurers may offer it automatically or leave the decision to the policy owner. Professional management. Segregated funds are managed by professional investment managers hired by the insurance company. This allows the average investor to achieve their investment goals without having to be actively involved in the day-to-day management of their portfolio. Exemption from probate fees. A significant advantage of segregated funds is that the death benefit proceeds are generally not subject to probate fees if a beneficiary other than the deceased's estate is named. This can potentially save the beneficiary thousands of dollars and allows for the value to be received within days, unlike the months it can take for an estate to go through probate. Tax benefits. Segregated funds provide several tax advantages. The insurance company tracks the adjusted cost base, ACB, of the fund, which simplifies tax reporting for the investor. In a non-registered account, investment income such as interest, dividends, and capital gains are passed through to the investor and reported on their tax return. Investor protection. Assuries, a not-for-profit organization, provides protection to segregated fund contract owners if an insurance company becomes insolvent. Assuries guarantees that a contract owner will retain up to $60,000 or 85% of their guaranteed value, whichever is higher. Protection from creditors. Segregated funds can offer protection from creditors' claims because they are considered insurance contracts. This protection applies if the beneficiary is a family member, spouse, child, parent, or grandchild, the beneficiary is irrevocable, or the account is a registered account. Limitations of segregated funds. Risk to capital. While segregated funds provide guarantees, the standard contract with a 75% guarantee means an investor could still lose up to 25% of their capital. Sales charges and MERS. Segregated funds may have sales charges, known as a load, which can be either a front-end load FEL, paid at the time of purchase, or a deferred sales charge, DSC, paid upon withdrawal or surrender within a specified period. The management expense ratio, MER, for segregated funds is also typically higher than for mutual funds because it includes the cost of maintaining the guarantees. These fees can significantly reduce investor returns over time. Term to maturity. A standard segregated fund contract is a long-term investment with a minimum term of 10 years. If an investor needs to make a withdrawal before the maturity date, they do not receive the benefit of the maturity guarantee and only get the market value of their units, minus any applicable fees. Age restrictions. There are age limitations for establishing a contract and making deposits, which vary depending on whether the account is registered, like an RRSP, or non-registered.